What you might not know is that Dell, Dell, the guys maybe your laptop is from, their stock is doing better than Nvidia this year. Dell is up 267%, Nvidia is up 188%. Now, Nvidia, it makes sense in my opinion. They had stellar earnings, huge AI demand, and while I personally do not feel comfortable owning the stock because I don't know where it's gonna go, with Dell, nothing really happened. We look at the revenue and sure, it has been slightly growing, but overall it's been flat since around 2019. Their free cash flow also not much better, around 6 billion per year on average, except for the pandemic boom of course. No shares have been bought back in that time as well, so I'm really asking, what is going on with Dell? Well, we can see they're starting to raise their dividend, and that is because of one big thing. They reached their core leverage ratio. They had a huge amount of debt. Their net debt reached around $40 billion, and they've been slowly paying that down. So now they're gonna pay out more in dividends and also buy back shares. So yes, that is great news for Dell shareholders, but that does not explain the stock being up over 200% this year. Here comes the magic word, AI, well positioned to capture AI opportunity. Because they don't only sell PCs. They have infrastructure solutions and client solutions. And their margins here in the infrastructure solution are way higher than in the client solution. This is something like laptops and that, but they have servers and networking and storage here. This is where the hype is coming from, that AI is gonna help them. Well, so far, minus 7% year over year, I do not really see the AI coming in. Nvidia already had their boom, they're still having it. They had way better demand than before. So shouldn't the demand, if it has been there, already appear? They're saying AI demand was strong, with AI optimized servers orders revenue up 40% sequentially. Well, that is nice to say, but your revenue is down in the category. Of course the AI optimized server orders are gonna be up. Those are your newer servers. Obviously your new product is gonna sell better than the old one. That is like Apple saying, hey, the new iPhone is selling 40% more than before, but in exchange your old iPhones are selling 40% less if your revenue is flat. This is just nonsense in my opinion. Sure, maybe they're gonna have great AI demand over there, but if they already are saying, hey, AI demand is going strong and going well, but the revenue is not growing, well then I'm asking, when is the AI demand gonna kick in? Yes, they produce a good amount of cash flows. This is a story like HP in my opinion, of course in a slightly different segment. They produce good, reliable cash flow. They're guiding for 3 to 4% revenue growth. I would say they can easily achieve that. 8% earnings per share growth, which means probably a lot of buybacks, maybe some margin improvements, but it is mainly gonna be that we're gonna be able to return a lot of cash to buy back a lot of shares, just like HP has done. Reliable cash flow, buy back shares, slowly grow over time. Wait, cash flow hasn't moved. It is around 6 billion per year on average, but on a 120 billion market cap, I'm paying a 20 multiple for 3 to 4% in revenue growth. The only reason why the stock is up so much this year, the price to free cash flow ratio. Ignore the spike, that is when free cash flow basically disappeared 1 year, but overall we can see they've been trading at around a 6 to 10 multiple free cash flow, and now they're re-rated at a 20 multiple. So this 200% return has only been a multiple adjustment. I like HP, I don't personally own the stock, but it is an interesting play because of a low multiple and the huge amount of reliable cash flow. Dell has a huge amount of reliable free cash flow, but now it is a high multiple. I would rather buy Apple at the 28 free cash flow multiple. I don't personally own Apple and I think it's quite an expensive stock, but I think Dell at 20 is very expensive. Currently they have around $7.1 in free cash flow per share if you take out the stock-based compensation. 8% growth over the next 10 years, that includes 4% revenue growth, higher end on the expectations, but why not? Plus 4% in buybacks, which is going to be quite hard to do. They already traded a very high multiple. It would basically take all their free cash flow to buy back those shares, but let's believe it's going to happen. 20% payout ratio with a little deduction due to taxes, 13 multiple. If no fast growth is going to appear, I don't see it trading at 20. $82 a share, 50% below the current value. So, not a buy, not something for the watch list. Now, what if AI is going to happen? So 8% growth and 4% in share buybacks. 8% growth for this company would be fantastic. Slowing down a bit to 10% at an 18 multiple, well then $140 a share, still not a buy. And this is with extremely high expectations in my opinion. I don't see what Dell stock has. Maybe I'm missing something, but with Nvidia I see the revenue is coming in. I wouldn't want to own it because I don't know when the massive capex spending into AI is gonna stop. I don't know at which level it will flatten out, but at least Nvidia makes some sense. And Dell just doesn't. I'm gonna pass on this. What do you think? Write it below. Have a good day.